Okay, so here is the paradox of the day. Shopify CEO casually mentions that AI is now writing well over 50% of their entire code base. They process another $100 billion in commerce this quarter, and yet the stock completely cratered this morning.
Yeah, it's almost like Wall Street doesn't care about your highly efficient robot developers if the bottom line suddenly looks terrifying.
Right. Welcome to Earnings Unscripted. It is May 5th, 2026, and we are unpacking Shopify, ticker SHOP, and their first quarter print. And before we try to figure out why the market threw a fit, quick reminder that we are just two people arguing about spreadsheets, so none of this is financial advice.
Definitely not, though I think a lot of retail investors could probably use a hug today. I mean, the tape was just brutal.
Yeah, it has been a really tough quarter for them overall.
Exactly. The stock was already down about 30% over the last few months, and then today they gapped down almost 9% in the pre-market. It just kept bleeding through the regular session down to $106, roughly a 15% drop on the day.
Which is wild, because if you just look at what the company actually does, powering online checkout for anyone selling a t-shirt in their garage, all the way up to massive enterprises, the core engine looks completely fine.
It does. The top line was very solid.
Yeah, revenue came in at $3.17 billion. That is up 34% year over year. And gross merchandise volume passed $100 billion for the second quarter in a row. So where is the panic coming from? Because operating income was down, but not horribly.
Operating income dropped to $382 million, which, yes, that's a sequential drop from Q4, but typical for retail seasonality. The real shock value was the net income line.
Okay.
It swung to a net loss of $581 million, down from a profit of $743 million last quarter. They didn't even specify a clean EPS number on the release, but you don't really need one when your bottom line swings downward by over $1 billion.
Wow. But hold on. A swing that violent is rarely just internal spending, right? Is that a accounting ghost?
Totally. It is almost pure mark-to-market pain. They took a $941 million hit on their equity investments. So the outside companies they own shares in went down in value on paper. It basically has zero impact on their actual cash burn.
Okay, so Wall Street is just panicking over a paper loss. That feels a bit too simple for a 15% sell-off.
No, you're right. Wall Street knows it is paper math. The real issue, the thing that actually broke the narrative today, is their credit book. Shopify's transaction and loan losses hit $116 million this quarter.
Oh, right, because they do merchant cash advances now. They're basically acting as a bank to keep these small stores running.
Precisely. They have over $2 billion in net loans sitting on the balance sheet. And when delinquency metrics start ticking up to almost 4% of revenue, the market freaks out. Software companies get high valuation multiples because software is clean and predictable. Lending is dirty.
Yeah, nobody wants to pay 135 PE ratio to hold traditional banking risk.
Bingo.
All right, that makes perfect sense. Let's get into the details on that, because I really want to understand if the massive AI efficiency they are seeing under the hood is enough to offset these banking headaches.
Well, that is exactly the calculus you have to do today. Because if you look under the hood, what they are doing on the product side is, honestly, it is staggering. They're essentially replacing entire external web and marketing agencies with native software.
Right, and you mean the coding thing, because I mentioned that 50% stat in the intro, and it honestly still sounds a little made up.
I know, but Harley Finkelstein was incredibly specific. The quote from the call was, AI right now writes well over 50% of our code today, and that number is going up significantly, which totally explains how they're shipping over 300 features with basically a flat engineering headcount. They are running a software sweatshop, but the sweat belongs to GPUs.
Okay, that is dark but highly efficient. But it's not just their own internal engineers, right? They're handing these bots directly to the merchants, too.
Yes, and this is where it actually hits the income statement. They have this AI agent called Sidekick. The weekly active shops using it spiked 4 times year over year, and nearly half of all their enterprise automated workflows, what they call Shopify flows, were actually built by Sidekick this quarter.
Oh, wow. Because I was reading through the transcript and they mentioned this unnamed accessories brand. Did you catch that anecdote?
Vaguely. Refresh my memory.
Yeah, so this small brand apparently got a massive celebrity endorsement on Instagram, just completely out of nowhere, totally viral. And Sidekick's Pulse feature independently realized the traffic was spiking, prompted the merchant to generate a social proof page, and then just built and launched the whole thing in minutes. A human team would take what, like 3 weeks to brief and execute that?
Exactly. They are taking what used to be a massive friction point for small businesses and turning it into an automated reflex. Finkelstein literally said there is simply no job that will be more accelerated by AI than entrepreneurship.
Okay, yes, but that hosting cost matters, though. If merchant adoption of these large language models is quadrupling, there has to be a ceiling where those API calls start chewing into gross margins. They cannot just eat server costs forever without charging a premium tier.
That is a very fair point. Gross profit margin percentage was slightly compressed sequentially, mostly standard seasonality, but those costs are real. I think, though, they are totally willing to subsidize Sidekick because of the deeper structural play they are making, the UCP.
Right, the Universal Commerce Protocol?
Yeah, this might actually be the most important thing they announced. Shopify essentially created an open standard for agentic commerce. So if a user is inside ChatGPT or Microsoft Copilot and says, buy me a black t-shirt, UCP is the hidden settlement rail that executes the checkout right inside the bot.
Okay, except wait, aren't Amazon and Stripe supposed to be fighting them for that exact space?
Normally they would, but Shopify got there first, built the rails, and made it an open standard. So now Amazon, Meta, Google, and most recently Stripe have all actually joined the UCP Council. Finkelstein was almost gloating. He pointed out that UCP is becoming the industry standard, and Shopify built it.
Jeez, that is incredibly strategic. So while the market is having a complete meltdown over some loan defaults today, Shopify is quietly wiring the infrastructure so every AI bot on the internet effectively pays them a toll.
Pretty much. They are inheriting a bit of traditional banking risk today for what looks like a structural monopoly on the AI checkout layer tomorrow.
Fascinating. So where does that leave them heading into the rest of the year? Because balancing this aggressive tech dominance against a wobbly credit book feels like a really complicated tightrope.
It is, but I think they actually have a bit of a buffer, at least a technical one, heading into next quarter. Look, they are guiding for high 20s revenue growth, which is solid, but the real trick is this upcoming accounting shift for the credit stuff.
Wait, an accounting shift for the credit stuff?
Exactly. CFO Jeff Hoffmeister mentioned they are transitioning how they book those merchant cash advances, mostly due to Canadian regulations, so it aligns with standard capital loans. He flat out said it provides roughly a 0.5% tailwind to free cash flow margins for Q2.
Okay, that is incredibly convenient timing, right? Right as the market starts freaking out over loan losses, they suddenly uncover a 0.5-point cash flow boost in the ledger.
I mean, yes, but you also have to give them credit for real operating discipline. OPEX is expected to come in around 35 to 36% of revenue. Actually, sorry, that is down from 37% a year prior, even with all the intense AI scaling costs.
Which loops right back to the bots writing the code. They are quite literally automating away their own expense bloat. But, the core business story is just so stable underneath it all. I noticed Huffmeister said almost 90% of their revenue came from merchants who had been on the platform for more than a year. The churn is virtually non-existent.
Right. The SaaS engine is pristine. The problem is just the valuation multiple. At a 135 PE ratio, the market demands absolute perfection. You cannot have foreign exchange tailwinds shrink, which they are expecting next quarter, and you definitely cannot afford a leaky loan book.
So basically, they have built this beautiful, futuristic, self-coding toll booth for the internet, but Wall Street is entirely fixated on the muddy driveway.
That is the perfect summary. It's a spectacular tech company getting severely punished today for acting like a mediocre bank.
Let's just see if Harley can teach the Sidekick AI to collect on those loan defaults by Q3.
Honest to God, I would not bet against it at this point.
Me neither. All right, let's leave it there before we start overthinking what the bots will automate next.
So if you'd like these earnings chats to just drop into your feed automatically, you might want to follow the podcast. And as a quick heads up, this entire show is an AI experiment, meaning our voices and the script are actually model generated to see how well machines can narrate real financial data. We would love your feedback or any ticker requests, so just shoot an email to earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for listening and catch you next time.
See you out there.